my name's Kangleas. I'm a portfolio manager at Vunani Private Clients. I've been a stockbroker for the past 18 years, and my speciality is in private client trading and in proprietary trading. Proprietary trading being the brokers who trade predominantly for themselves, or they trade for the house itself, for the stockbroking firm themselves. It takes a lot of planning for your trades. You have to plan firstly how long your holding period is, which is an important part of proprietary trading. You have to plan the size of your trades, and then you also have to plan if you do get into trouble, how are you going to get out of that. And proprietary traders tend to trade from a couple of minutes per trade to 2 or 3 hours per trade to a one-day trade, or intraday traders, if you want to call them in. What you need to understand is that the markets move in different directions at different times in the day. So from 9 o'clock or 8:30 when the futures market opens to 9 o'clock when the equity market opens, there are certain traders that trade that particular time. From 9 to 11, the market trades actively, and then from 11 to about 2:30, the market tends to shut down. You need to then be able to adjust your trading strategy to those times. From 2:30 to 4:00 or 5 o'clock, there's active trading again once New York comes in. And at those times, you again need to adjust your holding period. You need to adjust your size of your trades so that you can trade more effectively. There's always been day traders. Jobbers or day traders have always been in the market. You always have stockbrokers that have purchased and sold in the same day. It became fashionable once we started going electronic and once the internet was accessible to everyone. And the man in the street was then able to trade online. Around about 2000, 2001, 2002, day trading was probably at its peak. But I think what happened then was if we see markets coming off and markets being very volatile, then the day traders, if they're not disciplined, will then lose a lot of money. You have to adjust the way that you trade based on where you think the market is in terms of is it a trending market or is it a trading market. If it's a trending market, you can buy something in the morning and sell it in the afternoon, and you can do that every single day. Or sell in the morning and buy it back in the afternoon. That is a trending market. When there's volatility in the market, when the market moves up 200 points in the morning and then turns around and goes 300 points down in the same day, that is when you require discipline and knowledge of where to turn around and where to go in the other direction. Day traders do not marry their shares. They only get on the bandwagon of the direction. If you cannot adjust to the direction of the market, that's where you fail. As a day trader, what you really are doing is, like I said earlier, you're jumping on the bandwagon of the market direction. If you cannot affect a direction yourself, then you might as well just get on the bandwagon. You utilize basic techniques or technical analysis if you want to, where you can trade breaks, changes in direction, moving averages. You can utilize any technical analysis on day trading, and it can be quite effective. What you need to realize is that not all technical analysis is going to work, because most technical analysis was written prior to tick charts coming out in terms of daily trades. Utilize that, and you utilize the rest of the world's markets. We follow the Dow Jones futures. I follow the euro dollar quite closely, because it is a front runner in terms of where the Dow is going to go. The FTSE then in London will follow that, and the DAX will follow the euro. So all of those put together gives me an idea of where the market is going. And that'll give me a direction for the next 5, 10, 20 minutes. And once once you know the direction, get on the bandwagon. Once you don't know where the market is going, get off and wait. The range of instruments that you can use or trade, the Aussie is probably the most liquid, the easiest to get in and out of, the least cost. And if the Aussie's margin is too high, you can utilize the ALMI, which is a tenth of the Aussie. That'll give you a tenth exposure to the whole market at a very minimal cost. As a day trader, you're trying to minimize your cost in terms of trading costs and increase your profit and loss, or your profits. Then you can trade shares that are slightly less liquid than the top 40 shares, but then make sure that you'll be able to get out in the day. Make sure that you understand the liquidity of the stock. Make sure that you understand who the players are in that share, and you're able to exit your position at a particular point. The risks on the illiquid stocks or the less liquid stocks are that if you cannot get out, you have to cross a spread, then probably losing money on the spread. Intuition does play a major part in picking the right stock, knowing who the players are in that share, knowing if there's a big seller in the market, or knowing if there's a big buyer in the market. That type of intuition comes from watching and actually monitoring the shares that you trade constantly. You have to have that knowledge of the share. You have to know the liquidity of the share. You have to know which direction that share will go if other circumstances change. And will those players still be there if there's a major change in the rest of the world economies, or there's a change in circumstances? Stop losses, you have to again go back to intuition and go and say, why is the share at this particular point, at this particular price? Why is the share at this particular price? And then you have to make a decision based on the judgment that you make on, you put all the pieces together and make a decision on stop losses. I do take stop losses, and I do take stop losses based on where I think that particular share will break down, where the buyers will break down. And it's all about a little war between buyers and sellers. The more the buyers, the share will move up. The greater or the stronger the sellers are, the share will move down. But strength also comes, or in both sides, comes in a stealthy way in markets where people don't show their hands, but they are there. You need to pick up who the buyers and sellers are. Emotions are extremely important because you have to withdraw all emotions when trading. You cannot have an attachment to a share. You cannot have an attachment to a loss or a profit. You have to withdraw and look at the trade as just a movement of shares from one end to the other. If you achieve your goal, or if you don't achieve your goal, make the decision straight away to exit or increase. 90% of my trades have to be successful, and that comes back to making sure that I get in at the right time and get out at the right time. That is my goal, and that's my target, and that's what I try to achieve. The other side of my trades could be institutions, it could be other day traders, it could be algorithms. The reason I only trade local is that I know the market. I understand the market better than what I understand the US market or the FTSE. And I'd rather trade something that I do understand than what I don't.